In this video, I want to show you how you can master the daily candle bias. This video will totally change the way you see the market. In fact, this is one of the best videos, one of the greatest videos you will ever watch when it has to do with forex trading, because once you get your daily bias right, you are on the right track and you're going to make a better trading decision. But once you've gotten your daily bias clearly, every other thing begins to align on your lower time frame. Now, the aim of this video is to demystify and to simplify the concept of daily bias and to help you to be at the right side of the market always, so that you can be able to make profits. Okay, I just need to do some background introduction. Many of you may be aware about this. If you've been following my previous videos on daily candle, you should know this concept of the daily open, candle open, low, close, and high, and all that. But for some of you who are new to this, let me just do this brief recap, please. This is for a bullish candle. This is a bullish candle. For a bullish candle, the candle opens right there, okay, and then makes a low here, then goes up, trades up to the high, makes a high, and now closes here. Okay, and you are aware that it is this way. It still obeys the principle of AMD. AMD means accumulation, manipulation, and distribution. The candle opens on the Asian session, all right, revert, comes down, breaks out of the range at the London open, which then this is the open, this is the accumulation, others accumulated. Now the low of the day is made for a bullish candle at the London breakout here, and now the market trades up in the distributive phase. This is called the manipulation, whereby the retail traders are manipulated into thinking there's a sell, a breakout of this range to sell, and now the market makers now manipulates the traders to sell, and then takes out all their stop losses in the buy position on this buy move, and now makes the high of the day, and now closes with this. Okay, this is the daily AMD. Okay, for the bullish candle. For the bearish candle, for the bearish scenario, the market opens right here. Okay, market opens right there, makes the high, and now distributes down, okay, to the low, and now closes right there. That is for the bearish scenario. You can, it's something like this, appears this way. Market opens, trades high, okay, opens with the accumulation, trades high with the manipulation phase. Retail traders are manipulating into taking a buy trade, and now their stop losses are raided by this distribution, all right, distribution sell, and now the market makes the low of the day, okay, and closes right there. Okay, so that is the bearish AMD. Okay, so now that's enough for the introduction. Now let us move forward. So I've just depicted it right here. I've depicted it right there. Bullish scenario, market opens, makes a low, trades high of the day, and closes right there. And for the bearish scenario, the market opens, trades high, okay, distributes down to the low, and closes right there. This is for you to see how the market makers do the AMD: open, low, high, close. For bullish, the market opens, goes low, goes high, and closes. For the bearish, the market opens, goes high, makes the high of the day, trades low, and closes. Okay, so you can see these two concepts. It's very important you know them. Okay, now what is daily bias? The daily bias means or refers to the expected market direction, whether it's going to be bullish or bearish, that we anticipate that the currency pair will move towards during a specific day. That is the daily bias in a nutshell. The previous day's high and the previous day's low are important when you want to identify the daily bias, because the previous day's low and the previous day's high are used to draw liquidity. The previous day's high is a liquidity point. A lot of stop losses are there. Previous day's low is also a liquidity point. Most times they are swept. They're either swept or the price or the reverse from there. Okay, the market makers sweep liquidity at the previous day's high and at the previous day's low most times before they continue the market, or they reverse the market from there. Okay, so, and it's a reference point for potential reversals or continuation. So you need to know the previous day's high, and the previous day's low. They are very, very important when it comes to trading, knowing what the market bias is for a particular day. Now you can see the previous day's high here. Okay, so this is the for this candle. This is a bullish candle. You can see the previous day's high, and this is the previous day's low. It is very, very important you know the previous day's high and low. For this is for either bullish or bearish. It's just like this. It's the same. Okay, the previous day's high and the previous day's low. This is liquidity pool. Okay, this is a liquidity pool, and if you want to know more about liquidity, go and view my previous video on liquidity. I'm going to link it on this video. Okay, liquidity is retailer stop losses that are aimed to be swept by the market makers, okay, or institutional traders. So liquidity most times appear at the previous day's high and the previous day's low, and so for a daily candle, and the aim is the aim is for the institutional traders or market makers to sweep this liquidity. To sweep them means to take them out, to raid them, okay, to raid the liquidity. And once these utilities are raided, they will either do two things. They will either continue this to the direction, they will break the previous day's high or break the previous day's low, continue in that direction, or they reverse, or they can reverse the market. But liquidities are most times swept. Okay, liquidities are swept, stop losses are swept, retailer stop losses are swept before the reversal, or they continue in that direction. So you need to understand the previous day's high and low. And so now I want to talk about how to determine the daily bias. There are three ways. There are three important things you need to know when it comes to daily bias. You can have a continuation, or you can have a reversal at the daily candle. All right, previous day's high or low. You can have continuation, you can have reversal, and sometimes the market could be indecisive. Okay, at the indecisive phase, I'm going to tell you what to do. At the continuation phase, reversal phase, the decisive phase, indecisive phase, I'm going to show you the right way to know that the market is what the market is doing at the daily candle and how to approach it on the lower time frame. Now, the purpose of knowing the daily candle is to know what you're going to do at the lower time frame. Okay, so this daily candle, when you wake up in the morning, you need to look at the daily candle. Okay, when you look at the daily candle, it would inform you on what you need to do at the lower time frame. So this is D1. So once you see the D1, if you see the D1 in this form, or in this form, or in this form, you now know what to do on your 15 minutes time frame, or your 5 minutes, or your 5 minutes time frame, or even your 30 minutes time frame. Okay, or even 30 minutes time frame. These are lower time frames, okay, that I work with. Okay, so by the D1 will tell you what you need to do, the direction of the market for that particular day. Okay, the direction of the market for that particular day. Now let us see for the first rule. So for continuation, because the continuation can either be bullish continuation, or bearish continuation. Okay, now if the market closes above the previous day's high, the price action will likely attempt to surpass the new daily high. What does that mean? Okay, now if the price closes above the previous day's high, now price action will likely surpass the new daily high. I'm going to show you what that means. Now look at it, what I mean. What I mean is this. Now this is the candle for the previous day. Okay, this is the previous day's candle, and this is the high, and this is the low. Okay, this is the high and this is the low. So now, if this new candle, this is the daily candle, this new candle here, this new candle breaks this previous day's high, you can see the previous day's high has been broken by this candle. And when we say broken, we don't mean the wick, we mean the body close. This is the wick. I'm not talking about the wick, the body. This body here, this is the daily close. The daily candle close is closed above this previous day's high. Okay, so the candle closed here, this new daily candle closed here, closed above this daily candle. So this is daily candle close. Okay, so now for the next day, we want to see the next candle. So for the next day, what is going to happen to this candle for this next day? So that is what's going to happen, and that is why I just said this is one for the next day. The market price action will likely break the new daily high. So what is the new daily high? This is the new daily high here. So if this happens, this setup, once I see this in the past 2 days, my current day My current day candle is supposed to break this daily high. Okay, my current day's candle is supposed to break that daily high. Okay, see what I mean? My current day's candle is expected to break this new high because of what happened here. Okay, now this is what I mean. Okay, you see now, this is what so this candle closed above this closed above this. Now is expected as well. So when it closed above this, we now have the new daily high. This is the new daily high. This new candle as well for the next third day is supposed to break above. So this is day 1, day 2, day 3. So if my day 1 and day 2 appear in this form, my third day, which is my current day, is supposed to break this high. This is what you need to know. And let me show you an example. I've marked on the chart so we don't waste time. So you can see here, this is the day 1, this is day 2, and my third day, assuming this is where we are on the chart, you can see that this broke this. Okay, so this candle closed above this daily high. Now this makes this new high. Okay, daily high 1, daily high 2. Now my third daily candle supposed to break the new daily high. So it's supposed to break this high. So that is the principle. For the bearish scenario, if price closes below, it's just the reverse. If price closes below the previous day's low, the price action will likely attempt to surpass the new daily low. It's just the flip side. This is day 1, okay, day 1. This is day 2, day 2. Now my day 3 is supposed to break below. Okay, it's supposed to break below because of this formation. My day 3 is supposed to break below. Okay, because my day 2 broke, my day 2 closed. This is the candle close. It closed below this previous day's low. Okay, now that is to say this is the new, makes a new low. Now this second candle now makes a new daily low. So my third day, which is the day I'm assuming this is, I'm on the third day. Okay, I need to look at the 2 previous days. So the third day, I'm expecting that price action will smash this liquidity, will smash this, will break below this. Okay, that is the third day. Price action is going to take out this because of what has happened here, the first day and second day. Now let us see what I mean. So you can see here that this is my day 1, day 1 daily high. So this candle closed here and took out this liquidity here. So in my third day, which is the day I'm supposed, I assume I'm on my third day because I'm going to have to look at the 2 previous days. So this is a new daily high broken by this candle. So on the lower time frame, I need to look for bearish setups. Okay, I need to look for bearish setups. Trade mitigations down. I need to aim to break this low. Okay, take out liquidity on this line. I need to break this low. For a bullish scenario, once I've seen this, day 1, day 2, okay, this is the new high. I will look for a buy that will break this. I'll look for buy. I will know that the market is going up, so I'll look for a demand zone. I'll trade demand, look for a good demand zone that would actually take out this liquidity. Okay, I'll trade up because this, it shows me that my daily bias is bullish. Okay, this pattern shows me day 1, day 2 bullish, and this high was broken by day 2. Day 1's high was broken by day 2's body close. Now my day 3 most definitely or most likely, high probability would take out the new daily high of day 2. Okay, this is my day 3. So that is how you determine your daily bias for the bullish and for the bearish. Okay, for the continuation, day 1, okay, body close, broke that, and this now. So I look for, as I told you, I look for bearish setup that would mitigation that would take out that daily high, daily low liquidity. Okay, so that is it actually. Now let us see a chart example. Okay, this is a chart example showing you how this works. So this is day 1, assumingly broken by this body close of this candle to the low side. So assuming this is where I am, I will need to look for setups on a lower time frame that will take out this liquidity on the daily low. The daily low for the previous day will be broken because of my 2 days low, 2 days candle, daily candle having bearish and closing below the daily below the previous day's low. Okay, I hope that is clear. Now let us look for let's see the reversal phase. Now the second scenario is to trade it as a reversal, to trade the daily candle, to know the daily candle bias, the reversal, to know when you're going to have a reversal on a daily candle, or by looking at the daily candle when you're going to have a reversal. Okay, so now so the rule is for the bullish side is that if price fails to close below the previous day's low, price action will likely reverse and try to take out a new daily high. Okay, let me just show you on the chart. So if for any reason when you open your chart on the morning, this is your previous day, day 1, and this is day 2. Okay, so now the price failed to close. This is bearish scenario. Price supposed to this is a bearish candles, 2 bearish candle here. Price, this daily close now for this new day supposed to close below this. Okay, the body is supposed to close below this. This is supposed to be the close, but price failed to close. Price failed. It closed. It didn't close below. It closed. I'm talking about the body close, not the wick. So the body did not close below. Okay, did not close below this previous day for day 1. Okay, so that is to tell me that the market is going to reverse. The market is the third day. The market should reverse and take out this new daily high. Okay, the market should reverse on the third day. It's expected that the market will reverse on the third day and take out this new daily high instead of selling. It's not going to sell because this previous day's low was not broken by the candle, but by the body candle close. All right, so that is to say that the third day the market is supposed to be bullish, even though the 2 previous days we are somewhat bearish. Okay, let me show you what I mean. Okay, this is what I mean. Okay, so this is what I mean. So this is day 1, day 2. So this is bullish because this body failed. This body failed to close below the previous days. It failed to close below the previous day's low, and therefore there was a bullish candle. The market for the third day was bullish and took out the new daily high. Okay, took out the new daily high because of this. Okay, so that is it. So let me show you on the chart an example. There are 2 examples I marked right there. I'm just using the same GBP USD to show you that it happens almost every day. So because the first case I showed you here and I showed it there, so I'm showing you here now. So the first example for the continuation for the bullish I showed you right there. For the second example for the continuation of bullish I showed you right there, and I'm showing you now for the reversal. So this shows you that this happens every day. All right, you need to know how to determine your bias. Very, very important. Now, for you see now this candle, this is my day 1 candle. Okay, see this body close the body did not close below. The body of the second day of day 2 did not close below the low. All right, it did not close below the low. So in that case, instead of having a third candle, bearish candle, it now reversed. Okay, there was a reversal. I don't know, can you see it clearly? So this third candle reversed because this body candle close, or the 2 did not close below the day 1 candle. Okay, so third day, and I'm going to look for demand zones I'm going to trade on. That will also break. You see now it traded above, broke the new daily high. It broke the new daily high for day 2. Okay, that is it for the bullish scenario. Now for the bearish scenario, if price fails to close above the previous day's high, for the bearish scenario, price fails to close above the previous day's high, price action will likely reverse and try to take out the new daily low. Let us see what I mean. Now you can see here that this is day 1 candle, and ordinarily this is supposed to be a bearish, this is supposed to be a bullish market. Okay, supposed to be a bullish market, but this daily close for the second day failed to close above the previous day's high. This body candle did not close above the previous day's high, but it closed within the previous day's high and low. So in that case, instead of having the third candle bullish, is going to be bearish, and the bearish candle will take out this new daily low. All right, it will take out this new daily low. So this is what I mean. So because this is day 1, day 2, and this is the high and this is the low. Okay, so this body did not close above this high. In that case, my third day, which is my current day, would be bearish instead of bullish. Okay, it will be bearish instead of bullish. Okay, So let us see on the chart. Let us see on the chart. Now, I've marked it on the chart. I've marked it on the chart. Okay, so here, this is my day 1, my day 2, and my day 3. Okay, so here, for my day 1, this is the high and this is the low. So this body did not close above. So because it did not close above the previous day's high, the third day, which is my current day, would be what? Will be bearish. And because it's bearish, it's also going to took out the previous day's low. Okay, that is the principle. You remember what we stated? It's going to take out the new daily low will be taken out by this reversal. So this is the bearish reversal. Now let's look for the indecisive. So now, if you found value from what I'm sharing with you from this video and any other video I've been sharing on this YouTube channel, please give these videos a thumbs up, okay? And give this video a thumbs up. Share our videos with your friends, with your other traders, and comment on the comment section. Let me know if you found value, okay? Because I'm doing these are what people charge thousands of pounds or thousands of dollars to teach, but I'm sharing these gems for you for free, okay? That shows you that I have more. For me to share these ones so that I still have more in stock. I have more in stock. But the way you respond by appreciating me, by giving these videos thumbs up and sharing it and subscribing will determine if I'm going to release more of the gems that I have. I have more. For me to have released this means I have more in stock for you. Okay? Now let us continue. So indecisive. If price fails to surpass the previous day's high and low, it is wise to continue following the daily bias. Okay? The daily bias, if I'm going to show you if it's going to be buy, it means that the daily bias was bullish. Okay, now let us see the chart. Now it's divided into two. We have the indecisive A, that is for bullish. So if the price fails to surpass the previous day's high and low, if price fails to surpass the previous day's high and low, you need to target the previous day's high. Okay, if the previous day's bias was bullish. Let us see clearly on the candle. Now, what it means is this. For this day now, okay, for this day, this is the previous day's high, previous day's low, okay? Now, this market closed below. This candle closed below. It neither took out the previous day's low, it didn't take it out, and it neither took out the previous day's high. Okay, the candle did not take out the close of this candle did not take out this, and did not take out this, did not take out any of them, did not take out. It closed within the previous day's high and the previous day's low. Now, what will be this candle? What will now be on this day, the third day? Okay, this is day 1, this is day 2. So what will now happen? So what will happen in this case is that I would follow the bias of this candle. Okay, it's gonna be bullish, most likely gonna be bullish, because even though this second day candle did not take out high or low, I'll follow the bias of this. This third candle has to be bullish. I'll just ignore this and follow this. It's going to break this daily candle high. For this, because of this is going to be bullish. Now let us see what it means on the chart. Now you see, this candle did not take out this high, did not take out this. I'm going to use this as a bias. So this candle now shows me that it's going to be bullish, even though this candle did not take out, they neither took out the high or the low of this day 1 candle. Since day 2 did not give us any direction, so I'm going to reference day 1 to determine my bias. Let us see on the chart. So you can see here, this is day 1, this is the day 1 candle, day 2 candle, and day 3 candle. Okay, so here this is high and this is low. So this candle did not take out the high and did not take out the low. It's just within, did not take out the high or the low. So what will now be my day 3? My day 3, I'll be referencing day 1 to determine my day 3, which is going to be what? Bullish. Okay, so did you see it? This is the formation here. Day 1, day 2, day 3. Day 1, bullish. Day 2 did not take out high or low. So day 3 will be what? Bullish. Okay, so that is, and it will not only will it be bullish, it will take out all this, it will take out to clear this high, to clear the high. Now let us see for the flip side. So indecisive candle for B, the bearish side. So if the price fails to surpass the previous day's high or low, So you need to target the previous day's low if the previous day's bias was bearish. Okay, now let us see what I mean. So here, this is your day 1, this is your day 2, okay, and this is the previous day's high for your day 1. This candle did not take out this high and did not take out this low. So what will now be my third day? How will I determine my third? I'll just ignore this candle and follow this. Day 1 will determine my day 2, my day 3, which is going to be bearish, because day 1 is what? Bearish, and all this hard low will be taken out. This previous day's low will be taken out. So this is what I mean. Okay, this is your day 1. Day 2 did not give us a bias because it's indecisive. It did not break the former day candles high or low. So day 3 will take reference from day 1, and it's going to be what? Be bearish. Okay, but it's going to take out all this liquidity below. It's going to be bearish. Okay, so that is it. Let us see an example. So okay, the example now is this. Got these 3 candles. Okay, got those 3 candles right there. Okay, so this is bearish. This is bearish, high and low. This day 2 candle did not take out this and did not take out this. Okay, did not take them out. So I'll now take reference from day 1. Okay, it's going to be what? Bearish, and all these lows will be taken out. And this candle, this is my day 3 candle. So what is the reference? So when I've seen this, when I know that day 3 will be bearish, I will now step down to my lower time frame to look for supply zones I'm gonna trade, and I'm gonna target this low. This low will be swept most likely because of this principle. This low will be swept. So I hope you found value from this video. If you found value from this video, please do not fail to subscribe to this YouTube channel. Give this video a thumbs up. Okay, go and back test these principles, and your trading career will be transformed. I'm releasing gems to you. I know the value of what I'm giving you, and I'm doing that because I want you to succeed in your trading career. But you need to reciprocate this gesture by subscribing, by sharing our videos, recommend our videos to other traders. Give me a comment on the comment section to let me know that you enjoyed this, you learned a thing or two from this video. And if you want me to train you, okay, if you want me to mentor you, I have several people I'm mentoring and they are doing great things. Okay, you want me to mentor you one-on-one? I don't do collective mentorship, I do personal mentorship to take you by the hand and help you to become a profitable forex trader. You want me to do that for you? Send me a message. My contact detail is in our free Telegram channel. The link to the free Telegram channel where I share free setups and analysis is in the description box of this video. All right, do not fail to contact me if you want me to train you personally one-on-one. Okay, so till I come your way next time with another useful content, another useful video, do have a wonderful day ahead. Bye.